Welcome everyone to this video wrap-up of our Australian Equities sector review for 2017. I'm joined here today by our co-leads of Australian Equities, Shailesh, Jain and Adrian Ho. But just quickly, I thought I'd start by just letting everyone know about how we have restructured the Australian Equity offering. It used to be done on a super cycle basis, but we decided to get, in an attempt to get greater sector specialisation, we've actually split it into traditional and specialised, and Adrian and Shailesh will talk about some of the themes today. Shailesh, we might start with you and the traditional sector. So the question that's always on everyone's minds is some of the ratings actions that we've taken. So if you could talk everyone through some of the upgrades and downgrades and some of the new managers.
Thank you, Peter. As Peter highlighted, we've split the universe into specialised and traditional. 175 products. We've got about 16 of us working in the sector. It's a massive sector. So within traditional space, which I lead, we've got 96 products, and those are divided into subsectors of growth, value, core, style neutral. We've got income-focused, dividend-focused income strategies, we've geared, and multi-manager strategies. We also have a couple active ETFs, which is a growing part of the universe. We can touch on that later. In terms of ratings action, it's probably the movement in ratings has been probably slightly more than what we've seen historically. There's been about 20% change in ratings, predominantly to do with downgrades. Unfortunately, and we had 3 new products we've added to the universe. We had about 4 upgrades, and all of those concentrated within the concentrated strategies that have more concentrated offerings. The reason for downgrades is varied, but essentially it's either managers refocusing on the products that are being offered in the market due to the push to indexing and low-cost offerings. So a lot of fund managers have looked at their offerings and rationalised what's being offered in the market. Also, we've seen the push towards the more direct channels, the ETFs, LICs, partly due to push towards the IFA market. We've seen people move from the vertically aligned banks to more independent financial advisors. So what's that done is we've seen a lot of ETFs, listed investment companies, come to the market, and that's put pressure on the traditional managed fund sector. What's that done? We've seen about eight of these 8 to 9 products being pulled from the rating process, so ceased coverage. That's essentially been how the rating movements happened this year.
It's obviously been a volatile time in equity markets of late. So a follow-up question is, in terms of the traditional space, what's the performance been like in terms of alpha generation? And also, are you seeing a lot of divergence between, say, value and growth style?
Absolutely. I mean, if you look at it from a long-term perspective, unfortunately, Aussie equities have, again, struggled. Over a 10-year period, Aussie equities have struggled relative to global equities. But if you look within... recently that's changed in a short-term measure. If you look at it, Aussie equities have done reasonably well. But on a style basis, last year, we've seen value perform relatively strongly compared to, say, core and growth type of investments. And largely driven, for value sector, largely driven by the materials, the resources sector. Materials have had a standout performance over the last year, and industrials have suffered. Most of the managers within our universe have a slight overweight towards these industrial type of companies, and that's why the sector, whilst the value sector has outperformed the value index, has generally had a tougher time to outperform. The broader universe has had a tougher time to outperform this over the 2017 period.
Look, just one last question for you, Shailesh, before we turn to Adrian. In terms of the research agenda and also with markets having rallied strongly, are you finding that the incumbent managers are starting to get some capacity concerns? And what's Lonsec's approach to that?
It's a very interesting question because it's one thing we focused on a lot more this year, have been focusing for the last few years. It's become an ongoing issue now, also because of the top end of the fund managers are getting too big. They've got managing a lot of money, so it's an issue, and a lot of managers have gone down the market cap to see because there was alpha found within the small cap space. So if you're carrying a lot of money and you're going down the market cap, it's an issue. Liquidity is an issue. Getting in and out of stocks is an issue. So what we've done, we've created a model, essentially to look for the fund managers managing across. So we get a look through on what they're managing within the global space and within Aussie equity strategies, and also we looked at their investment style, the turnover, and all those different aspects, and that's all been inbuilt within the model. And then what it's done is giving us a bit more clarity around how much money or at what point the managers can have some issues with capacity. And we've seen that's been a big issue, and we've seen a couple of rating actions at the back of that. We've seen a couple of downgrades, despite funds performing reasonably well last year. I think on a forward-looking basis, we think capacity is a big issue, and we've taken some rating actions at the back of that.
Great, thanks Shailesh. Thanks for explaining that house view. Look, just turning to Adrian now and to the specialised sector. I guess we'd start with a similar question. So, in terms of ratings actions, new funds, trends that you and the team have witnessed in the specialised sector this year.
Yeah, sure. Thanks, Pete. Well, just to give a brief summary of the sector, or lay of the land, so to speak. The specialised sector really is everything that is classified as a non-traditional Australian equities strategy. So that includes things like long-short funds, absolute return funds, anything with the derivatives basically involved, so equity income, and also some of the direct channel type products, so SMAs and LICs. So I guess the big sort of development over the past year has been growth in products rated in the direct channel in particular, so LICs and SMAs. So we've seen 12 new entrants into the sector. 3 have been long short, 1 equity income, 5 new SMAs and 3 LICs. In terms of ratings movements, it's been fairly evenly spread. I'd say that a little bit different from the traditional in that we've seen mainly upgrades. So 8 upgrades sort of evenly spread across sectors. There hasn't sort of been any sort of general pattern to those upgrades other than sort of an increase in conviction in our existing managers.
And with us being quite late in the cycle in terms of this bull market, have you seen a return to interest in more defensive strategies like long shorts? And can you give us a rundown in terms of how we've gone about splitting it into beta 1 and variable beta?
Yeah, sure. So I guess continuing on that theme of sector specialisation, we've gone along the path of further delineating the long-short sector into variable beta and beta 1 type strategies. So that basically means we're drawing a distinction between strategies which can alter their net equity exposure from say a traditional long-only fund, which would be would have equity exposure equal into the market, and so that we've classified as an active extension sub-sector peer group, and drawing a distinction between those funds and funds which can actively vary the beta, which we've called, funnily enough, variable beta. So yes, the reason for that is, again, performance comparisons, sector specializations, just to improve our sort of peer review comparisons and hopefully improve the quality of our work.
Terrific. Another issue that's been a live one in the market's been around the equity income funds. Mm-hmm. It's just in a period of previously dampened volatility, and now with a volatility spike of late. Yeah. Just to provide a snapshot of how that sector's gone and some of the issues and how managers are dealing with it.
So the equity income space has been a very sort of hot topic button sector for maybe the last 2 years. 2016 really saw the sector really be under trouble. We saw it was basically a perfect storm for those funds. We've had an environment of low volatility. We've had sort of poor performance in terms of absolute returns and strong outflows, which makes it more difficult for managers to navigate through that environment. So consequently, during that year, you saw large outflows and poor performance from that sector. So 2017, I guess positively or pleasingly, we saw the sector improve or stabilise. Volatility was still in patches improved, which means it rose slightly. And we've seen, I guess, the sector recover in terms of performance. That said, performance has still been below benchmark, which is to be expected given the way that they run strategies, a bit more defensive in nature and income oriented. But yes, a more pleasing year.
Great. And just look, finally, in terms of the specialised sector, the LIC coverage has grown strongly in terms of the secondary market coverage for Lonsec. So could you give our subscribers a sense of what's driven that and the sort of products that you've picked up ratings on over the last 12 months?
Yeah, sure. So that's really goes alongside with the growth in the direct space in LIC. So a lot of, as I mentioned earlier, we've picked up 5 new LICs in the space. Now, while they're new to Lonsec in terms of ratings coverage, many of these LICs have been operating in the market for quite some time and have been sort of well established in the market, for instance, Argo and Digiware and the likes. So what's driven their sort of increased market attention and subsequently our coverage has been, as Shailesh has mentioned earlier, an increased focus on the direct channel and away from sort of traditional managed fund sort of distribution outlets, and I guess the rise of the self-managed super fund space. So, yeah.
Great. Okay, well, thank you very much, everyone, for joining us and watching this video and gaining some of the insights from our sector experts in Australian equities. And we look forward to completing the 2018 review and giving you further insights within the next sort of 12-month period. Thank you very much.